All right, in this section, we're going to learn a little bit about determining what you can afford. That's often a question I get. And so this one may be assessing your current situation, looking at saying, hey, are we over leveraged and do we need to shed some things? But it's also, I hope, can be a proactive tool as you begin to look at things in the future and determining what you can afford. So I'm going to use some principles determining, and I'm going to use a couple different approaches. The first one is what's called the income approach. So first principle here in determining what you can afford. I often am in the housing industry, and I'll have people call me and say, hey, Brett, how much can I afford to get into a home? Well, it's important to note what those calculations are, and I believe if you can have those calculations done ahead of schedule, it can help you. Remember, when you talk to a loan officer, they are selling money. Their job is to sell money. And so be aware of that when you come in. Already have your numbers figured out of what is an appropriate threshold. So I hope these tools will be helpful. HUD, the Housing and Urban Development Department, FHA is another thing that you often hear about, has recommended debt ratio thresholds. The first one we talk about is your housing debt ratio. So they recommend that no more than 31% of your gross income goes towards your housing expense. So I've used in the example here, if you have $7,000 a month in gross income, you multiply that by 0.31 or 31%, and that means that no more than $2,170 should be going towards your rent or housing expense. That does not include utilities and other things like that. That is for your actual expense. If you had a homeowners association due, that would go into that payment. So like for a home, it'd be your principal and interest payment, it would be your taxes, your homeowner's insurance, if you have mortgage insurance, and then your HOA due. So that should not be more than $2,170. Your total debt ratio calculation is that it should stay below 43% of your gross income. So once again, using the example of the $7,000, multiply that by 0.43, that means that no more than $3,010 a month should be going towards payments. And you'll see that that's car loans. That's your payment on that, your minimum payment on a credit card, student loan. On your student loans, use the fully amortizing payment. Don't use an income-based repayment plan on there, because on your income-based repayment, you're never going to pay it off. And so use a fully amortizing payment when you're determining what that is, because if you don't use that, then you're going to get in upside down to where you can't do anything other than make the income-based repayment, and you don't want to be trapped. So in that example, if you're at $3,010 a month for total allowable expenses going out, subtract that payment $2,170, that means that you've got $840 a month that could potentially be going to other type of consumer debts on those payments. So I want to point out that these are the maximums, and this is important. You don't want to live on the edge of your income. I would encourage you to set thresholds under there, counsel together, and determine what you can do. We learned about in the last segment using a budget. Write out all your hard expenses and take your housing component out of it and see what you have left, to see what you have of actual dollars to spend for a house payment. Then when you talk to a loan officer, you can be telling them, look, hey, we can afford $1,800 a month. I don't want to go over $1,800. They can then work those numbers and programs backwards for you on determining how much you can afford. So those are also based on average lifestyles. And I want to note that the average American never creates wealth. And so if you live to the edge of those calculations, if you're asking people what can I afford, they're going to tell you that. Even beyond that, it's important to know you can actually get approved on a lot of these loans up to 50 to 55% of your gross income. We can do what's called an automated approval throughout the industry. And a lot of people you talk to, they're trying to get the maximum amount of commission, both real estate agents or somebody selling you a car. And so they're putting a lot of pressure on the loan officer. What's the maximum these guys can qualify for because they want to make a bigger sale for more commission? We just have to be wise enough to see that. And so you control your budget. So hopefully those thresholds help you on determining how much you can afford from an income approach. So that's one approach. The more important one that not as many people talk about is determining if you can afford it by a net worth approach. And I find this incredibly powerful. This one may be discouraging to some people, but I find that if you can address it, look at it, you can actually begin to create incredible financial independence and wealth for you and your family. So this is done by determining first what your net worth is, and that's subtracting your assets from your liabilities. I like this definition that's been given here. The asset puts money in your pocket every month. If you're talking to an accountant, An accountant's going to create a different balance sheet. They're going to put everything that is of value in the asset category. The definition to create wealth, I'm going to suggest, is that it puts money in your pocket every month. You'll see why in just a minute. A liability is just the counterpart. It takes money out of your pocket every month. And so let's look at a couple of those definitions. So if I use the example of a 401k and why this is important, let's say you had $30,000 in a 401k making 8% as a return. Well, if you have a car, even paid off, this is important, Art, that car takes money out of my pocket every single month. I'm going to have insurance costs on it, I'm going to have taxes and license. You're going to have your maintenance, everything coming on that vehicle. And so that's taking money out of our pocket. If you got $30,000 over there, even paid off, statistics show that it depreciates at about 8%. So my net worth is actually, I may have $40,000 over here in my 401k, $40,000 over here on in the car, even though it's paid off, both doing 8%, my net number is zero. I'm creating no wealth. I have no income coming in. Say you have a savings account with $10,000 in it, making 0.25%, and you have a $10,000 ATV. And let's say that one you've got a car or a loan against it for 5% and 8%. Once again, that's going down at 13%. You're only making 0.25%. You're moving backwards. A lot of people make the argument, but I get tax benefits on some of this. You're still spending $1 if your tax bracket is 21%, you're still spending $1 to save 21 cents. And so this is incredibly powerful and important. Your income is your number one driver of your net worth. And the goal really of that net worth is to get to a point where you don't have to be reliant on going to a job every month, that you have financial freedom. And one question I often ask people is, your money going to outlive you, or are you going to outlive your money? If you can't answer that, there might be room and help for this in asking the question, can we afford it? So a couple other principles on this. I'm often asked, how much do I need to be able to retire or to step away from my job? Well, to me, the answer is really simple. Let's say that you're making $60,000 a year right now, and you're comfortable. All your needs are met, and it's a lifestyle that you enjoy. Do you have $60,000 coming in from other sources of income other than the job that you go to every day? If not, then there has to be work done in this area to get it to where you want to go. So the goal of that net worth is that it's income producing. Maybe I'll back up to that last concept that I was going over. For example, this one's hard. Let's think about our home. If we look at it by definition, our primary residence, the world would say that our home is our biggest asset. By that definition, it can be our biggest liability. Even if our home's paid off, it still takes, once again, the utilities to maintain that insurance. We got taxes on it. That's taking money out. And to be financially free, if you want to go serve a mission, or you want to go travel, or you want to be able to have the income to go do certain things, if you have a home that's paid off and no income, you still don't have any options. You're actually in a very dangerous situation. And so it's important that you're looking at income producing assets. A second home, some people may call that a big asset, but my definition is it would also be in the liability category. If you had an investment property that was generating cash flow for you, that would be an asset. And so it's important to take some time and break that down and be real. I encourage you to actually write out your net worth statement using that as a background and see what that number is, because this next number here, this example, let's say your net worth is $1 million. So you've done that calculation and it's generating, let's say you use an 8% return. Well, that's $80,000 a year in income coming in. That's power. You can be sitting on the beach in Hawaii making that $80,000 a year when you have more assets than liabilities. And so you need to have a plan for building your net worth. It is it's a process that you go through. I would encourage you to have a net worth goal. A lot of people set income goals every year. I want to make X amount. I want to get this much of a raise, or I want to increase my income by $10,000 this year. That's helpful, but I think the bigger opportunity to get to financial freedom and independence so that you can serve how you want to serve and live how you want to live is actually to set a net worth goal. Perhaps that's to increase your net worth by $30,000 this year. That may come in a combination of paying down some debts, additional debts, and putting more money towards some investments. So, but have a plan and be specific in what that is. And then when making decisions as a family, I would encourage you to ask it, can we afford it by net worth, not by net income? And it's a different process as you go through that. Once again, I'm in the housing industry, and I have a lot of clients that come in, and let's say that they had a home they purchased for $200,000. It's gone up to $300,000. Pay their mortgage down to say $150,000, so they have $150,000 in equity. They'll look at it and say, Brett, I got a pay raise since then. From an income approach, can I afford more home? I'm going to take that $150,000 and put it on a $500,000 home. Well, from an income approach, it's going to pencil on the debt ratio all day long. But if they do their balance sheet and really create that net worth statement, perhaps they can't afford it. And it's very different when you start to have those discussions. Now, this is one that I think becomes very personal between you and your spouse, and I think it's great to have a financial advisor to be able to bounce these ideas off and create a strategy. For example, let's say that you want to be able to retire at age 60 with $80,000 a year in income. That's something you can plan for. You can create a process that you'll know how much that net worth needs to be to accomplish that, and be able to accomplish that far into the future if you've set the net worth goal. But you may start to look at it and say, hey, we can't take that $150,000 and go to a more expensive home, because that more expensive home is going to strip out more income. It's going to have higher utilities, it's going to have higher taxes, it's going to have a higher mortgage payment, and we don't have any extra net income. And so a principle I would share is your income grows, keep your baseline low. And you will be able to create incredible wealth. It's also important to note, I think this doesn't mean that you're always going to be poor. This comes back to the principle, if you'll do the hardest things first, life will always become easier. Focusing on this, you will come to the point where your assets are way larger than your liabilities. You have enough income coming in from all your other sources, whether you go to your day job or not. And you have financial freedom and flexibility to actually go and buy some things that you really, really, really enjoy. I think you can also begin to make decisions as you move along on timing, whether to wait all the way till retirement and save every penny till you get retired, or enjoy the journey with the kids. It's just a great way to go through it and determine money is just a theme. What are you using it for, and how's it delivering your dreams, and how does it align with what we've been called upon here to do on the earth? Hopefully that helps, and good luck on creating your net worth sheet.